Recessions and declining home values are not new phenomena. During the Great Depression of 1929, the same kinds of occurrences were taking place. When the word recession is spoken, people instantly begin to tremble with fear. The recent recession of 2008 resulted in the housing market collapsing, and people started to understand the intimate link between the property market and the economy. Given this, there are certain benefits and downsides to the recession's effect on the housing market. How much of an impact will this situation have on the housing market? Is the recession an advantageous time to purchase a home? Let us investigate these variables in further detail. In this video, we will go over how the recession is impacting the housing market. Make sure to watch until the end because you'll find it insightful. You may be asking, what is a recession? A recession is a macroeconomic phrase that refers to a considerable fall in a region's overall economic activity. Historically, it was defined as 2 consecutive quarters of economic contraction, as measured by GDP and monthly indications such as an increase in unemployment. However, the National Bureau of Economic Research, which officially proclaims recessions, has said that 2 consecutive quarters of real GDP drop is no longer considered a recession. The NBER defines a recession as a prolonged period of considerably lower economic activity throughout the economy, often shown in real GDP, real income, employment, industrial output, and wholesale retail sales. Here are some recent recessions. The 2008 recession. From 2007 until 2009, the 2008 recession took place. The mortgage business saw a downturn as a consequence of subprime mortgage rates. As a consequence, the real estate business entered a period of decline. When lenders began offering subprime mortgages, demand for houses soared, and as a consequence, property prices climbed. Borrowers eventually were unable to make their payments, and housing values plummeted. Above all, the financial institutions that were supposed to collect the money were unable to do so and declared bankruptcy. The recession and crisis occurred after a lengthy period of an increase in house building, home prices, and housing finance in the U.S. Between 1998 and 2006, the average price of a house in the U.S. more than doubled. The era dubbed the Great Moderation came to an end in 2006, when the decade-long growth of the market reached a zenith. Global financial markets started to experience difficulties in 2007 as a result of losses on mortgage-related financial assets. In response to the severity of the downturn and the sluggish pace of recovery, the Federal Reserve offered extraordinary monetary accommodation. Mortgage debt in the U.S. increased from a 61% GDP in 1998 to 97% in 2006. Between 2001 and 2005, employment and housing-related industries contributed to about 40% of net private sector job growth. Following the peak of property prices in early 2007, the degree to which prices would ultimately decrease became a prominent concern. Between the first quarter of 2007 and the second quarter of 2011, home values declined by more than a fifth on average throughout the country. This decrease in property values contributed to the onset of the 2008 financial crisis. Lehman Brothers filed for bankruptcy in September, and the Federal Reserve aided AIG. Not only was the housing industry at the center of the financial crisis, but it was also at the center of the larger economic collapse. Home investment and employment in residential buildings peaked in 2006. Initially, the fall in total economic activity was moderate, but it accelerated dramatically in 2008. Between the recession's peak, the U.S. gross domestic product plummeted by 4.3%, the greatest decline since World War II. The Federal Reserve cut its objective for the federal funds rate from 4.5% at the end of 2007 to 2% in September 2008 in reaction to worsening economic circumstances. The Federal Reserve began the first in a series of large-scale asset purchase operations in November 2008. These acquisitions were made with the intention of putting downward pressure on long-term interest rates and generally improving financial conditions. Numerous policies have been suggested or implemented to mitigate the danger of financial hardship. For conventional banks, the total amount of capital needed increased significantly. Additionally, the Dodd-Frank Act of 2010 included additional requirements governing how major financial companies are treated. Stress testing on a regular basis helped both banks and regulators in assessing risks. The 2020 recession. As the COVID-19 pandemic spread around the globe, company closures and corporate bankruptcies were common. As a consequence of pandemic disturbances, a property market slump was almost unavoidable. The 2020 recession was distinct from prior recessions in that it was precipitated not by the financial sector, but by the pandemic. There is no certainty that the recession will terminate after the epidemic has passed. As a consequence, the 2020 recession might be argued to be unrelated to the housing market. The market will be impacted by the recession, but it will not collapse like it did in the 2008 recession. Nonetheless, nobody will be interested in such a large financial investment in the home market, given the state of the economy. There were indicators of decline before the pandemic. In mid-2019, the U.S. yield curve reversed, which is often suggestive of an impending recession. Job losses began rapidly in March 2020. In 3 weeks in April, around 16 million Americans lost their jobs. Unemployment claims hit a new high of 3.3 million at the end of March. The previous high was 700,000 in 1982. However, in the last week of March, jobless claims reached a record high of 6.7 million, and by May 13th, new claims had surpassed 35 million. On May 8th, the Bureau of Labor Statistics announced a U3 unemployment rate of 14.7%, the highest level since 1941, and a U6 unemployment rate of 22.8%. That's total jobless plus marginally attached and part-time underemployed employees. Restaurant patronage plummeted precipitously throughout the country, and major airlines significantly cut their operations. All of the big three automobile manufacturers ceased operations. In April, new house construction projects fell by 30% to its lowest level in 5 years. Between February and May 2020, about 5.4 million Americans lost their health insurance due to job loss. Consumer expenditure declined by 7.5% in March of 2020, according to the U.S. Department of Commerce. It was the greatest monthly decline since 1959, when the statistic was first recorded. As a consequence, the country's GDP contracted by 4.8% in the first quarter of 2020. The CARES Act, the greatest economic stimulus package in American history, was signed into law on 27 March 2020. In May 2020, the Congressional Budget Office reported that the unemployment rate climbed from 3.5% in February to 14.7% in April, implying a loss of more than 25 million jobs and an additional 8 million workers. Job losses have been concentrated in areas reliant on in-person contacts, such as retail, education, healthcare, leisure, and hospitality. For example, in March and April, 8 of the 17 million leisure and hospitality jobs were eliminated. The economic effect was predicted to be disproportionately felt by smaller and newer enterprises, which often have less of a financial buffer. Between February and April, real inflation-adjusted consumer expenditure plummeted by 17% as social estrangement reached a zenith. In April, auto and light truck sales were 49% lower than the monthly average in late 2019. Mortgage applications decreased by 30% in April 2020 compared to April 2019. Real GDP was predicted to contract by roughly 38% annually in the second quarter, or 11.2% from the previous quarter, before returning to a positive quarterly growth of 5% in quarter 3 and 2.5% in quarter 4 of 2020. However, it was anticipated that real GDP would not restore its quarter 4 2019 level until 2022 or later. In 2020, the unemployment rate was expected to average 11.5%, dropping to 9.3% in 2021. Economic researcher Jim Cramer said in June 2020 that the reaction to the COVID-19 recession resulted in one of the largest wealth transfers to the ultra-rich in recent history. In July of 2020, it was revealed that the United States' second quarter gross domestic product had decreased at a 33% annualized pace. Now let's discuss COVID's impact on the housing market. As with any other industry, the housing sector has suffered as a consequence of the pandemic. Due to pandemic-related measures, homeowners are less inclined to welcome guests. Additionally, buyers are less inclined to pay a house visit for the same reason. As a consequence, fewer properties are available for purchase. Due to the statewide lockdowns, which have impacted purchases, house inspections, and even movers, the closing process has become even longer. Should you invest in real estate during this recession? As stated earlier, the primary issue is whether or not you should purchase a home during the current recession. In general, a recession results in a decrease in the market value of properties, since more sellers remain in business despite fewer purchasers. Additionally, since this recession is distinct from past ones, the buyer will be in a different financial condition. Let us examine some of the advantages and disadvantages of purchasing a home during the current crisis. Advantages. One significant advantage is that properties sell for less money since they remain on the market longer and sellers ultimately reduce their selling prices. Another advantage is cheaper mortgage rates, which occur when the Federal Reserve lowers interest rates during a recession. Disadvantages. To prevent being entangled in foreclosure scenarios, you must also consider the aspect of job instability as the unemployment rate continues to rise. Banks are less inclined to lend you money and approve mortgages as a consequence of the projected employment insecurity. Apart from the difficulties faced by real estate owners in selling their properties, you may have difficulties in selling your present property in order to purchase a new one. The solution. The ultimate answer to this issue is to engage a realtor who is more knowledgeable about the market than you are. This will save you a lot of time and money, as well as ensure that you move into your new house without incident. How do you feel about investing in real estate right now? What else would you like us to talk about in our upcoming videos? Let us know in the comments below, and make sure to subscribe and turn on notifications so you don't miss out on any of our videos.